Hi everyone, welcome to the BuyProperly webinar on Investing 101. It is December and it's bonus season and it's year end and we are going to be starting a new year shortly. This is a good time to be thinking about investing with all the spare cash that's going to come your way during the bonus season. And so if you've not been an active investor in the past, this is the right time to start thinking about it. And so we've decided to have a session on that. So giving you all a brief background of who we are and why we are having this webinar. We are BuyProperly. I'm Khushboo Jha, the CEO of BuyProperly. Our platform is for fractional real estate investing. And the idea is to allow people to be able to invest in real estate with as low as 2,500. We want everyone to be active investors across asset classes, including real estate, which for decades has been out of reach for a lot of people. And we try and make it as simple as possible. Clearly, our ambition is to make it a one-click purchase of property like Amazon does for goods, and that's where we are striving for. We have with us today Professor Chinmay Jain. Hello and welcome, Professor Chinmay. He is an assistant professor of finance at the State University of New York. He has completed his bachelor's in technology and industrial engineering from Indian Institute of Technology, Kharagpur, and has PhD in finance from University of Memphis, Tennessee. He's received several accolades and awards, and including like Financial Review Best Paper Award for his research paper on short selling. Apart from being a well-loved finance professor, Chinmay Jain is also an avid investor himself and has quite a lot of experience investing across asset classes, and I'm hoping he can give us some tips on that. So he invests in, correct me if I'm missing something, Professor Jain, stocks, bonds, real estate, Bitcoin, what am I missing? Like the broad spectrum of asset classes. So he would, I'm sure, be able to add value. But before we start, why don't we do a quick poll and then we will kick it off. The audience will have 60 seconds to give their votes. I see a lot of people are familiar with GICs and mutual funds, and which is great, which means people are getting more and more active. Sharing results with everyone here. Seems like 67% of the audience has knowledge of GICs, mutual funds, market trends, etc. So I think that's something for you, Professor Jain, when you are talking about some of the tips and tricks of investing.
Okay, thank you so much, Khushboo, for the introduction. So yeah, like you introduced, I also trade in options a lot,
Okay.
but I don't think today is a great session for talking about options trading. But I think we can talk about general asset classes today.
Yeah, maybe we need a separate session for advanced investors to talk about options as well. But talking about novice investors, I think for like even for me, even with all the finance degree and everything, I feel like I do nothing beyond what the company deducts towards RRSP, for example, and automatically enroll in the plan that is recommended to me. The biggest question is, as a novice investor, where do I really start? Like, how do I educate myself where do I get resources to figure out how do I start actively investing and building my wealth?
So firstly, I'll say kudos to you. I think this year and the past year, you organized a lot of sessions for investors to learn about different asset classes, how do they build their portfolio. So I think it is great for public to attend these sessions. I think you are
Thank
doing
you.
these as free sessions. So I think that is great to do. And also there are some other societies like CFA Society, they organize some sessions for public to attend. But I think before you can learn about investing, you should know what questions to ask. So I've seen a lot of times my neighbors ask me, "Hey Chinmay, you're a finance professor. What stock should I buy?" And definitely, if I knew which stock is going to go up, I would not have been working anymore. I would have bought Tesla at the beginning of this year. I would have bought Amazon 5, 10 years ago. So I don't think that's a great question to ask. I think that you should start by asking, how do you build a well-diversified portfolio? Like, should I invest in stock? Should I invest in bonds? Should I invest in real estate? And what are the differences between these different asset classes? What are the risks associated with each of them? And why should I invest in multiple asset classes? Is it enough if I just buy stocks, or is it enough if I just invest in real estate? So those are the kind of questions you need to ask. And I think there's a lot of information on the web out there, but I think it can be overwhelming. So like you are seeing all the sensational news on the web that, a 20-year-old is a millionaire because he bought Bitcoin when he was 12 years old. So now investors are thinking, should we buy Bitcoin? Somebody's saying that there's a news article last week that somebody made $500,000 from $5,000 by investing in Tesla options. Now you think, should I invest in Tesla options? So you need to be realistic about what your goals are. So you cannot be one of these exceptions who are making, 100 times of their money. So you have to be realistic about historically what kind of returns stocks have given. Should I expect 8 to 10% return? Should I expect more? Should I expect less? And it also depends on your goals. So you need to define your goals. You need to define when are you going to retire, how much income you need in your retirement, and you need to ask the right questions. And also it's a good idea to talk to some experts. So if somebody will ask me about how should they go about their portfolio, I'm sure I can give some valuable advice if they are no wise investor. So it's a great idea to talk to somebody who's an expert or who has some experience investing for some time.
Got it. And talking about investing and planning and making that a goal, I feel like maybe I've been there as well. When you start working and when you are busy, it feels like you don't have time to think about investing often, and maybe sometimes you don't have the money. So the question is, who should be thinking about investing? Like, how much savings do you need to start investing? And what's the first thing you put your money towards? So I decided that, okay, New Year's coming, and this new year, I'm going to build my investment portfolio because I want to grow my wealth. And investing is better than saving, which is better than spending, which I already did over Black Friday. But I think the question is, who should invest? How do I make my goals when I'm just starting out? And how much do I need to start?
Yes, so definitely if you have debt and that debt has a high interest rate, you should try to pay it off first. So let's say if you have a debt on your credit card where you have an interest rate of 20 to 25%, on the other hand, you're investing and you're making a 10% return, that doesn't make sense. So if you have a high interest rate debt, then you should not be investing. You should be first trying to pay it off. Or you should not be investing so much that you end up defaulting on your mortgage payment. You should know what your obligations are, and once you know you're able to fulfill them, then you should think about what can I do with the money that I'm saving. So if you are not an active investor, if you have not done investing before, I think it is a great idea to start by investing not in individual stocks but broad market based indexes. And I think one way to do that is to start investing in ETFs. So if you're a first time investor, I think you usually think about investing in stocks, which is not a bad idea. So you can invest in a S&P 500 ETF, or you can invest in NASDAQ 100 ETF. They are called as SPIDER and QQQ. and they trade on exchanges just like any other stock, and you can invest $100, or you can, because now a lot of platforms allow fractional investing. So even if you have $100 to invest, you can buy stock of Amazon if you wanted. So technology is changing this investing community a lot. So because of technology, you're able to buy fractional shares. Not only that, these new apps like Robinhood are letting people trade without any fees, and this caused competition in the brokerage field. Now, most of the brokers in the US do not charge any trading fees. So earlier, if you had $100 and if you had to pay a fee of $10 per trade, when you invest 100, you lose 10 right away. You have 90, and now when you sell it, you again have to pay $10. So you need to make at least 20% return to break even, but that's not the case anymore. So I think fractional investing and $0 trades have changed this investing field a lot. And even with $100, you can decide to start investing, because once you see investment in your portfolio, you want to invest more. You want, instead of going on a Black Friday, getting a Black Friday deal, you want to get shares because you feel good about saving. So I think even $100 is good enough to start investing.
That's a good tip. It kind of motivates to say I don't have to save up before I start investing, or I don't need a huge bonus before I start investing. I should probably just start. I did follow one of your tips on the QQQ index, and invested some money in March, which has done very well. So I followed one of your advices earlier this year. I hope to follow more of your advice.
It is easy to give advice. I did not buy QQQ in March. So, but I bought some Delta Airlines, which has done well. So I'm happy with that.
Got it. The other thing I wanted to talk about is the risk-return relationship. So in every asset class, and my inbox is full because I'm trying to follow all of the investing forums out there. Inbox is full of some of the things that you mentioned, where it's about how to become rich with flipping properties, how to become a millionaire over the next 5 years, how to become how to have leave your job over the next 2 years by renting out 5 properties and so on. And then the same applies to stocks. And like, these are the stocks that you need to buy to stop working and retire next year. So, and some of them, when you read up, have very attractive returns. Like even in real estate, you have asset classes like pre-construction, which is promising 20-25% return. And so it's very tempting to say, oh, why is that giving me 25%? Is that a better asset than this one that's giving me actually only 7% or 5% return? So I kind of wanted to connect with you on the risk-return relationship and how should one evaluate that aspect.
So generally, you can say that the higher the risk, the higher the return that you make. That's the relationship we see in the financial markets. So for example, if you compare stocks and bonds, so bonds are supposed to be less risky because when a firm goes bankrupt, the first claim to the assets are for the bondholders. So for that reason, the bondholders end up making less return than stockholders. So the higher the risk you take generally, the higher the return that you will make. So, if you want, I can share my screen and talk about the risk return, uh, the, the, the trade-off. So I'm going to share my screen now and share some slides with you that should help in answering this question. So first, I like to talk about basic. Do you see my screen now?
Yes.
Yeah. So first, I'd like to talk about the long-term performance of S&P 500. So when you're investing, you should always be thinking about long-term. So like if you are only investing for a month or 2 months, you cannot be sure what kind of returns you will make because market fluctuates. There are news out there every day. So you should always think about long-term investing. So if you had invested in, let's say, 2008 or 9, you had a return about 200% by now. So it doesn't matter when the market keeps going down because of bad news, it always comes back up. So this is one chart that tells you the differences between bond market and stocks. So you can see the line in the orange is the stock market. You can see it fluctuates more, so it is more risky. And while the blue line is the bond market, it doesn't fluctuate as much, but it gives you a lower return. So again, you are taking a higher risk in the stock market, and for that reason, the stockholders want a higher return than the bondholders. So what are the questions you need to ask to look at what is your risk appetite or risk tolerance? So one, age is a big factor. So when you're at 20s versus when you're in 50s, you want to have a different kind of portfolio. Because when you're in 50s, you only have another 10, 20 years to work for. But when you're in 20s, you have another 40, 50 years that you're going to work for. And then you have to look at your expenditures. Are you going to buy a house in the next 2 years? You're going to buy a house in the next 2 years. You don't want to take a risky investment because you want to have a down payment available for your house in 2 years. Are you going to go to grad schools in 2 or 3 years? And you need to save for that. And when are you going to retire? Also, every individual has a different risk tolerance level. So when you hire a financial advisor, usually they give you a questionnaire, you fill that questionnaire, and based on that, they judge that what kind of a risk appetite you have. So I just Googled that somewhere and found these are the kind of questions they ask you, like what is your age? What is your next major expenditure? And when do you expect to use most of the money you're accumulating in your investments? So these are the kind of standard surveys that financial advisors will ask you, the questions they will ask you, and then they'll judge that what kind of risk appetite you have. For example, Khushboo, if I asked you this question, that you are on a TV game show and you have won $10,000. Now they ask you, you can take $10,000 or you can have a 50% chance of winning $50,000. Or the chances go lower and lower, but the reward goes higher and higher. So what do you think? Which choice are you going to pick?
I'll probably take B. You can take some
Yeah,
risk.
yeah.
Not a lot.
So we can see, and also I think that's a good choice because if you multiply 50,000 by 0.5, the expected payoff is $25,000. But there's a likelihood you'll make zero,
Yeah.
right? So let's say if somebody had a real big need for $10,000, they thought that with this $10,000 I can start a business, right? They want that for sure. They maybe take choice A. But let's say in your case, if you don't make any money, you are okay. Maybe you have enough savings. You don't care if you get 10,000 for sure or not, but that 50,000 will be a big deal for you, right? So every individual investor is different. So when you're investing, definitely you need to look at your risk profile, your risk appetite, your risk tolerance. So that is one thing you need to be mindful about. And the second thing I want to talk about is whether you want to actively invest or you want to passively invest. So you can choose individual stocks. So you can buy Tesla tomorrow, you can buy Amazon tomorrow, or you can choose a mutual fund. So mutual funds usually will charge you 1 to 2% fees, and they will try to invest based on your theme. The third choice that I personally like is ETFs. So ETFs are exchange traded funds that trade on exchanges just like any stock, but they are usually passive investments. So can you imagine how many ETFs trade in the US market right now? Can you take a guess, Khushboo?
1,000, 10,000.
10,000 is a big number, but it's about $2,000, 2,000. So 2,325. And out of those, close to 2,000 are passive. So you can see that even when you're investing passively, your choices are so many. So investing passively doesn't mean that you don't know where your money is going. You can invest in different types of ETFs. So I'll show you some example on the next slide here. Uh, if you want to invest in, let's say, a broad market ETF, you can invest in SPDR or QQQ. But if you think that the technology sector is going to do well, you can invest in ARKK, QQQ. If you think solar energy is going to be big, you can invest in TAN. You can invest in consumer goods stocks ETF, airline industry ETF, precious metals ETF, or bonds ETF. So not only you can invest in stocks, you can actually invest in other sectors through ETFs. You can invest in bonds, commodities, real estate. So you can invest in alternative assets. So these are some advantages of ETFs. You can buy them and sell them throughout the day. But mutual funds, when you buy, you don't even know what price you're getting because they calculate the value at the end of the day. And also you can have tax benefits through ETFs because you can decide when do you want to book your profits. But these mutual funds, when they sell, they distribute the profits to the investors. And not only you can invest in broad market based indexes, you can invest in sector indexes as well. So there are a lot of benefits of ETFs. And not only that, the fees are very small. The fees can be like 10 basis points, 10 to 20 basis points. So lower fees as well as diversification. So these are some advantages that you have in ETF. And you can also trade on margin. So let's say if you have $100, but you can buy ETFs for about $200 by using margin trading. So, and also research has told us that if you were actively trading and if you are trying to pick stocks, then actually you lose 67 basis points by doing that. If you would have been better off if you had just switched to a passive market portfolio. And this is not true for just you and me. This is also true for professional fund managers. More than half of professional fund managers are not able to beat the benchmark that they have. So I would say that unless you think that you're really knowledgeable, you have a lot of resources and time on hand, I think passive investing is the way to go for investors like you and me. Although I consider myself a sophisticated investor, and also I like to show my class also that what kind of assets you can trade in. I like to show them how do you trade in options, how do you buy cryptocurrency. So for that reason, I like to trade in other asset classes actively as well. So I think I'll stop the sharing the screen now and I'll let you go to the next question, or we can see if the audience has any question.
Sure. So sounds good. I do have a question for you though, active versus passive investing. I feel like one of the inherent assumptions is that all the information about either the stock or the companies or the bond is out there. Like when we are talking about real estate, I wonder if the same would apply or not, and would love your opinion on that, because with real estate, when you're buying a house, there's a certain amount of idiosyncratic risk or that's specific to that unit, where there may be an advantage if I live in that neighborhood, for example. It's almost like having insider information. What do you think of
Yeah,
that?
so I would say, so when we talk about stocks, all stocks of Tesla are the same, right?
Yeah.
So all you have to do is do research about how Tesla is doing as a firm. And then when we move to bonds and options, it becomes more complicated. A company can issue several types of bonds. And then options, there can be options with different strike prices, different expiration date. I think when it comes to real estate, it becomes even more complex. I think no two units are the same. Even if you look at the same building, a condo on 9th floor is different from a condo on the 20th floor because of the view. So I think as far as real estate is concerned, I think there's a lot of different features that you need to know. You need to know about the school district that you are in. You need to know about when the unit was built. You need to look at if the basement is finished or not. There's so many factors that you need to look at. And later on, I want to show you a slide where I want to tell you that in case of real estate, actually individual investors can do better than these real estate REITs that are out there, or real estate funds that are out there. Because these REITs and real estate funds are actually investing in multiple units. So they are diversified. And so you cannot choose what unit you're going to invest in. But when it comes to real estate, if I live in Rochester right now, I know which part of Rochester is going to be in demand, what kind of people are moving here. So I do have some advantage compared to maybe even some professional investors when it comes to real estate. So I'll show you some research later on where it was shown that individual investors have overperformed some indices in real estate market.
I would absolutely love that, because we at Buy Properly believe in that strongly, because that's why we allow people to invest in individual properties. And the question we often get is, why is it not a fund? Well, a fund is almost a black box and you don't know what you're getting into. But then if you live in Toronto and if you know about Oakville, you know that it has good schools and the kind of people it has, and you have this extra advantage where if a unit in Oakville comes up for investing, you can make a better call or a better decision on the potential of that particular unit. So there is advantage in individual investing. It's just that it's too expensive and out of reach for most people to invest in. And you are very familiar with this on how expensive real estate in Toronto is. So buying a one bedroom is not something I can do every year, or like even once in several years, because even a one bedroom is $500,000 in Toronto. So that is why I think we are believers, and that's why the whole concept of buy properly, to allow people to invest fractionally, it has come in. Moving on, in terms of, we talked about where to start. So you say we can start with $100. Fractional investing is a great place because it allows you to buy expensive stocks, etc. And then we talked about the risk-return relationship. Before we move on, I just wanted to run a quick poll to see how people think of investing. In 1 second. Let me open the poll and see what influences people's decisions on investments. Again, as last time, we will have 60 seconds to do this. See a lot of online research. All right. Well, it looks like most people do online research to make their investment decisions. Cool. So moving on from that, I think we have a few questions before we get into more questions from my side. So one of the questions is, historically, which asset class has performed the best in terms of risk-return trade-off? That is, give maximum returns for a given amount of risk.
So I would say it has been the stocks. But then you can talk about what kind of stocks have given you higher returns. So has it been small stocks or the big stocks or large firms? Has it been value stocks or growth stocks? So you can talk about that. So generally small stocks have a higher premium, risk premium, so they give you a higher return than large stocks, but they are risky also. And value stocks tend to give you a higher return, but in the last 10 years, we have seen like growth stocks have done very well because of the tech sector. But if we only talk about asset class, I think stocks have done very well. But if you consider cryptocurrency as an asset class, they are a relatively new asset class. So you can say Bitcoin has outperformed stocks, but it is also has a very high risk associated with it. So
that is, there's another question on Bitcoin. So now that you bring it up, can you shed some light on investing in crypto/Bitcoin? How to start and what type of investors does it cater to? How much of prior crypto knowledge is required to invest?
So
you invest in this sector, so you're probably very well placed to speak both from the theory perspective and the personal experience perspective of investing.
yeah, so I cannot talk about which coin to invest in. So although I own some Bitcoins, so but I'm not going to tell you that buy Bitcoin or buy Ether or buy some other coin. But I just want to say that I think generally the digital currencies are going to get bigger and bigger. Now, which one will be more popular, it's hard to say. But we can see now a lot of financial institutions are also giving approval to cryptocurrencies. Now, lately, just a few weeks ago, PayPal allowed retail investors to buy cryptocurrency on their platform. So you can buy cryptocurrencies on platform. Now, the type of knowledge, I think it caters to retail investors as well. So I think as a retail investors, you can buy cryptocurrency. Now, the knowledge that you require to invest in cryptocurrency, one thing that I would like you to learn is the concept of the public and private key. So when you buy cryptocurrency on exchange, you do not exactly own it, because if the exchange gets hacked, you will lose your cryptocurrency. So you need to move the cryptocurrency to your own wallet, so you have the ownership of the private key of the cryptocurrency. So I would like you to understand the concept of public key, private key, double spending, and what does miner do, what are blocks. So if you're ever interested in learning about this, you can send me an email. I'll be very happy to talk to you about it as well.
Sounds good. I think we have a hand up from Deepak. Deepak, would you like to ask your question?
So I see a question from Deepak about the Bitcoin bubble. So he's asking if there's a Bitcoin bubble similar to
I think he's speaking
2017.
now. Deepak, you're speaking?
Yeah. So Bitcoin went up to 20,000 in 2017, and again now it's running up, right? So is it going to continue to run up this time?
So again, that's a hard question to answer, but there's some evidence that there was some manipulation in the Bitcoin price in 2017. So there was an exchange called Bitfinex, and they were using Tether to manipulate the price of Bitcoin upward. But this time it seems a bit different because now there are more financial institutions that are driving this rally. So in 2017, it was retail investors. So, and also I think that now the millennials or the younger investors don't think of buying gold. They see cryptocurrency or as a digital gold. So I think that theme of seeing Bitcoin as digital gold is going up. And this time I'm seeing so many big names who are actually approving Bitcoin. So I personally like the idea of cryptocurrencies. It's hard to say which one is going to go up, but because Bitcoin has a large network effect, it has been there for the longest time. I think it's hard for it to get rid of Bitcoin, or Bitcoin will not go down or go away anytime soon. So I'm invested in Bitcoin personally, but I think there's so many tokens out there right now. There are thousands of tokens. If you go on icobench.com, you will see how many new ICOs are taking place. I do not keep track of all these tokens because I invest in options, I invest in stocks. I have 2 condos in GTA. I'm lucky enough, Khushboo, that I was actually able to buy actual condos and I didn't have to do fractional investing. But you made a very good point that we need fractional investing more in real estate than stocks. If I want to buy Amazon, I can still buy Amazon for $3,000. I cannot think of buying a condo anywhere for $3,000. So we need the fractional
Except on
investing.
our platform, because our minimum is 2,500, so you can potentially get a fraction of a condo on our platform for $3,000.
Yeah, or you can find a really bad property somewhere for $50,000, like foreclosed or something, and take a mortgage with a $3,000 down payment. But that's very, very unlikely. But I think I tried to answer Deepak's question that I don't see it as a bubble this year. And because I like the idea of these faster transactions, cheaper transactions, and the government is trying to print so much money this year, and there's inflation, so people need to buy something to hedge their risk. And instead of gold, it seems like people are interested in buying Bitcoin.
Thank you, Deepak. Moving on, I think now that we have talked about the risk return, the different kinds of asset classes, I think the next obvious one is having a diversified portfolio. It is a much talked about topic, and the question is, why is it valuable, and how do you make the optimal mix of assets in your portfolio? Where does, of course, I come from BuyProperly, so my obvious question is, where does real estate fit into this one?
Yeah, so first I'll briefly start by saying, why do we need diversification? So one is that a rational investor tries to maximize her return for a given level of risk. So, and that can be achieved only through diversifying your portfolio, because by diversifying your portfolio, You have several assets in your portfolio that are not perfectly correlated. So when one goes up, the other goes down, and it reduces the volatility of your portfolio. So what you can do is when you look at your risk appetite and when you answer a survey and you see that your risk appetite, you want to have aggressive growth portfolio, then you can have like 85% of a portfolio in stocks and 15% in bonds. But let's say if you are very conservative, you losing like 5% of your portfolio will make you lose your sleep, then you want to put less in stocks and more in bonds and short-term investments. So that's the idea of diversifying your portfolio. So when you have a retirement account with your company, usually they give you a choice of where you want to put your money. So you can put your money in stocks, you can put your money in fixed income, or can you have a target date portfolio. So let's say you think that you're going to retire in 2035, you put your money there and your retirement account manager will on its own balance your portfolio to have more bonds when you get closer to your retirement date. So again, how do you diversify your portfolio? You look at your risk appetite. So you have your investment policy statement, look at how many years you have until your retirement. And you also look at things like, does my spouse work? How risky is my job and how risky is her job? So in my case, my wife is a tenured professor. So I like to take more risk because I know that she's tenured, she has a job, and the chances that both of us lose our job is very, very low. And you look at what are your other income sources. Is it only your job or do you have other passive income sources? And you look at your goals and you want to see how much you want to invest. And then you look at how much income you need after retirement. So there are some online tools that help you do this. You can write down, you can input what is your age, when will you retire, how much money you make, and how much money you will need after retirement, and what is the kind of return you're expecting. So basically, I just wanted to give you an idea about what target date funds are. But definitely, if you want to have a good retirement life, you need to invest more than what you put in your retirement account, right? So what you want to do is, so far I talked to you about equity and bonds. So you want to put money in equity for sure. You want to put some money in bonds, although you don't need to start with that. But there are a lot of alternative investments. So there are some that are only available to sophisticated investors like private equity, hedge fund, venture capital. So those are harder for you to invest in, but you can invest in real estate, commodities, gold, silver, art, or wine. So what is the role of real estate? So I'll just compare the returns that real estate has given compared to stocks and bonds. So this is a return for the last 15 years. And you can see the middle three rows are stocks. You can see stocks have given return from 6 to 10%. And the last three rows are real estate indices. And they have given you about similar return with much less volatility. So it makes sense to add some portion of real estate in your portfolio. And it has been shown by research. So this is the risk return graph here. And you can see for any level of risk, so volatility is the x-axis. For any level of risk, if you only keep fixed income, which is bonds, and equity in your portfolio, your returns are much lower compared to when you add alternative asset. And I think real estate is a great alternative asset to put in your portfolio. So this is a figure given by Swenson, who's the endowment officer for Yale. And he also says in his research that you should put 20% of your portfolio in real estate. But again, like Khushboo said, if I've only saved $10,000 and 20% of that is $2,000, I cannot buy real estate with that, right? So my choices are either I buy some REITs, which are real estate investment trust, or go to a platform like BuyProperly where I can invest in a fractional ownership of real estate. And this is a long-term trend of real estate prices. You can see that it fluctuates much less compared to the stocks. So what is the advantage of real estate? Again, there's a high cash yield. You can rent the property. There's an equity buildup. There's no equity buildup in bonds or a GIC or a CD, as you call it in the US. You can use leverage in real estate. If you are taking a mortgage, you can take leverage. It is a physical asset, so it's not going to go bankrupt like a stock can go bankrupt, a firm can go bankrupt. And also the interest payments that you make for your mortgage, you can deduct it from your income. So there's a tax advantage here as well. So how do you invest in real estate? So I think I'm going to wrap up here. So basically you can do a direct investment, which we all agree is hard. Nobody has, or very few people have money to do a direct investment. It is much harder to diversify a portfolio. Even though I have two properties as my investment properties, they're both in GTA, which is a great place to invest. But I cannot have two properties in GTA, two properties in New York, two properties in California. That's harder for me to do. But you can do that if you invest in a fractional investment platform, or if you invest in REITs. So you can do indirect investment by using REITs or buying mortgage bonds, which will be like a debt. But there are some disadvantage of REITs, like we earlier talked about. They don't let you choose the property that you are investing in. And also most of the REITs invest in commercial properties. So when there's economy goes down, you see that the prices of commercial properties go down more than residential properties. So I think Khushboo can talk more about buy properly, but the last point I wanted to make is that individual investors perform better than REITs. So because they live close to the property, they know more about the area, and they can sometimes buy without a mortgage, so they can have a higher return compared to a REIT. So this is the conclusion of my presentation here, that you invest for long term, you diversify your portfolio based on your risk appetite, buy broad market indexes, and consider alternative assets other than stocks and bonds. And I think one thing I did not mention before, it's good to have some cash on hand for emergency fund, for something like pandemic, when a lot of people lost their jobs. So it's good to have some cash or liquid asset on hand. So I'll stop. Yeah, I'll stop
Thank you.
there.
And so, yeah, I think on that note, maybe it is, and since the audience already indicated that they do have some knowledge, just wanted to run a poll to see what is stopping people from having a diversified portfolio. Because portfolio diversification is much talked about these days across the various investing platforms that we have, and all the advertisements that we see around having a diversified presence. Okay, we'll have 60 seconds to vote for this as well. So Chinmay, if I may ask you, of your investments, what is your best performing asset class across the investments that you've made?
So although I consider myself a sophisticated investor, but my stocks haven't done very well. So I've not been a great stock picker. So my real estate investment has done better. So although historically stocks do better, but I haven't been able to do that myself. But I have a property in GTA in Whitby, so that has done very well. And then I bought a property in North York last year. So all the property prices have gone down slightly last year because of the pandemic, but because my horizon is long term, it doesn't affect me personally. So I think real estate has done very well for me.
Got it. Cool. So I think 50% of the people are indicating that they do have a diversified portfolio, which is awesome. And then the next big group is they haven't diversified because of lack of knowledge of options. That's kind of where it is. But in terms of how can people get more knowledge about what options they have, one of the challenges that is often faced is I feel like traditional institutions do not do enough to make information available or resources available to all kinds of people, like across demographics. So maybe younger people, maybe more women, like people who are otherwise not actively investing. And my question to you is, what can people who are like not initiated do to get more information apart from just doing online Google search? Like we hold seminars, there are lots of forums, but they are often catered to a certain demographic and does not necessarily include, for example, younger people who've just got their first job, or women who are maybe taking a career break. So do you have any advice on how some of these otherwise uncatered demographics do anything?
Yeah, so I agree with your point. And being a professor, I think sometimes we fail at educating the larger community. So I think we need to do a better job at that. So, like for example, in our school, I think the women students, the female students, do not take finance courses as much because there's a misconception that this field is for males. So I feel that women are underrepresented. And similarly, like people of color or younger people, so definitely the institutions are there to make money. So they will go after, they want to attract rich people because they are going to give them fees, higher fees. But I think they need to be more aware about can they educate the investors as well. Because that's not the only goal of corporations these days. Like ESG is a very important factor, like the corporate governance and what kind of changes are you bringing in the community. So ESG stocks are actually doing better these days. That is a big factor for firms, like educating investors, doing greater good for the society. So I think these institutions need to do a slightly better job of reaching out to the broader community. But at the same time, as a professor, I think we need to make sure that more and more people are taking at least a course on personal finance. Or we need to tell high schools that teach your students, like, how do you build a good credit score? How do you think about repaying your education loan? Like, what kind of options do you have down the line? So yeah, that's my opinion or viewpoint about that.
Got it. One question we have from the audience on portfolio diversification is there a downside to portfolio diversification? So we talked about all the benefits. Is there a risk that you may over diversify, which may reduce the returns? Also, how do you know that you have over diversified? How do we know that we have over diversified our portfolio?
So definitely, let's say at the beginning of March, if you had put all your money in stocks, you would have made a higher return than the case when you had diversified your portfolio. But you also need to understand you are also taking a higher risk. So the idea of diversifying your portfolio is to have maximum return per unit of risk that you are taking. So you are making a good return, let's say if you only had stocks, but when the stock market goes down, you will also make the poorest return if you are not diversified. So I think that's the idea of diversifying your portfolio. And if you if you want to take a high risk, and if you want to take a gamble, maybe you can do it. But I think if you want to maximize your return per unit of risk, which is what a rational investor likes to do, that's what I will suggest you do. And how do we know that we have over diversified our portfolio? So I think if you are actively investing, and if you invest in 50 stocks, and you don't know how to track them, like I don't know what that firm is doing, so I think that might be called as over diversifying, where you cannot even track your investments. So in that case, you might be better off buying an ETF. So you can diversify without having the need to track the performance of each individual stock.
Got it. The other question was real estate being a great alternate asset to add to a portfolio. Can you explain the pros and cons of investing in REITs versus fractional real estate? I mean, you covered some of that. I, of course, am a big proponent of fractional real estate because, like you mentioned, it allows you to maximize your returns rather than putting it in a black box because you may have effectively some inside information of the area that you're looking to invest in.
Also, most of the REITs are investing in commercial real estate, so that's another thing. And I think there was a need for a platform like yours. I think a platform comes up when there's a need, right? So you're solving a problem, and investors are invested in investing. So and the fractional investing is actually getting big in different asset classes now. So yeah.
There's another question. Are there any online platforms that retail investors can use to track their portfolio spread across multiple asset classes? I mean, I know of platforms, and Professor Jain, you can add to this. I know of platforms that kind of give you a portfolio based on what you're investing with them, but I don't know how, if at all, you can track across asset classes.
So I think this is something that you'll have to manually input in. So like go to a tool and tell them I have 100,000 in equity, 50,000 in real estate. And then as your asset classes perform, it will tell you different weights. But I don't know of any tool right now. I do it manually. Like I look at my portfolio myself. Yeah, so I'm not very sure about it, but you can definitely look at your retirement account and see how much you're invested in which asset class. And what you can do is you can use your retirement account for buying bonds, so you don't have to buy bonds yourself. So you can assign a percentage of your retirement account portfolio for bonds, so you don't have to buy bonds in your own investment portfolio. That's something you can do.
Yeah, I know we on our platform, not across asset classes, but at least across the various properties, we do allow people to track their portfolio and how it's performing across the properties. But that would be in the broader real estate investment space on the platform. So customers have a dashboard that they can use to track their various investments. And what the returns they are getting, what the cash flows they are getting, as well as what the fair market value is tracking. So if you invested in 2 to 3 properties on our platform, you will get to see how that portfolio builds up. And over time, of course, the assumption is that you'll be adding more properties to it. I think.
Yeah, so what I do is I have made a spreadsheet of my own. So where I put in what is the value of my interactive brokers account, what is the value of my cryptocurrencies. So I think it'll be hard for the reason that you cannot, it will invade the privacy. You cannot allow your cryptocurrency exchange account to interact with your stock portfolio account, right? So it will invade your privacy. Or so for that reason, I think some manual inputs might be needed.
Got it. Cool. There's another question from Deepak. When are you going to increase the number of property listings on the platform? Well, we do have a lot of properties coming in, I think, on the BuyProperly platform. Why don't you connect with somebody on the team, true for Deepak as well as the others, and actually just give us an indication if you're interested, because we have 5 or 6 that are going to go live right now. I think we're just putting together, curating the pictures and the virtual tour, given that there are no open houses and no physical checks possible. We're trying to create virtual tours and virtual walkthroughs for all of these properties that you can invest in. So yeah, if you guys are interested, somebody from our team will reach out and set up some time to talk about some of these options that we have on our platform right now.
So I have a question for you, Khushboo. So I know you have just started operations last year, but you're growing fast. But I think, will you at some point use blockchain in your business? So like, let's say you keep the transactions on the blockchain. I mean, is there any value addition by using blockchain in your transactions?
Kind of. So yes, but I think we did evaluate blockchain. So let me start by there. We did evaluate blockchain. In fact, when we were starting out, we did this small hackathon setup where we actually tried to do the whole transaction over blockchain and see how it works, and whether or not it will be valuable for us to do it that way. The challenge is there are so many external agents involved who are like, forget blockchain, it's difficult enough to get them online. Like the stakeholders that we work with, like an inspection report person or the KYC or the suitability assessment, the real estate agents that we work with, the brokerages, all of them, getting them to work online is in itself tough. Getting them to adopt something like blockchain is going to be some distance of travel before all of those stakeholders are in. And unless all of the stakeholders are on that blockchain, it is going to be difficult for us, because then one stakeholder will be basically doing it for other people. And then that kind of defeats the purpose of having this transparency where everybody is independently providing the information. So
Okay.
we do want to move this to blockchain, and yes, we will benefit, because then, especially in the case of, sorry, I forgot to share this, especially in the case of real estate, where there's so much information that you might miss out on. It would be good to have all of the information in one place. Otherwise, lots of things are not mentioned anywhere. For example, in Toronto, like even the house that I live in is more than 100 years old. I don't know what all has gone on in this house. I bought it based on what it looks like and what the external checks turned out to be. Now, there's a ceiling, actually the one here, leaks in. It looked perfectly fine when we were buying it. There's no way for us to know that there was a damage of any sort in the roof, which has been lingering for the last 25 years. So, but we were using blockchain, this information over time would get captured. So once I have entered it, the next buyer and the buyer after that, and 10 years down the line, would still be around, and it would not be editable, and nobody can take it away because it's the ultimate truth. So there is a lot of merit in having that in case of real estate, especially given that sometimes buildings and houses stay around for more than 100 years. And I wouldn't be around to tell the story of this house and what happened and what didn't happen. So it would be very beneficial for a future buyer, but we miss that information right now.
Okay.
Awesome. So I think we are almost out of time, but this was an absolutely fabulous session. Thank you for joining us. And I hope the audience, actually we have a bunch of questions come in, but we may have to address that later. I hope that the audience gained quite a bit from the session, and people are using their end of year savings towards investing rather than all towards spending. It's holiday season, it's a COVID year. So yes, some spending is cathartic and good for mental well-being, but maybe they will start investing and start thinking about having a more diversified portfolio. Thank you.
Thank you so much,
everyone
Khushboo.
for joining us.